Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Alasdair Macleod. He's one of our more frequent guests here. Alasdair writes a weekly column at goldmoney.com, and if you care at all about your economic future, you owe it to yourself, to your family, to your loved ones to read his column every week. And today I want to talk to Alasdair about an article he wrote on October 3rd called An Inflationary Depression, and I'll start out just Alasdair's his essays are always very good in the sense that the first you're introduced to it before you get into the meat of it. You have a big picture of what the story or what you're going to encounter. And he let in, just read the opening lines here from the October 3rd article that he wrote, An Inflationary Depression. He said, and I quote, "Financial markets are ignoring bearish developments in international trade, which coincide with the end of a long expansionary phase for credit. Both empirical evidence from the one occasion these conditions existed in the past and reasoned theory suggests that consequences of this collective folly will be enormous, undermining both financial asset values and fiat currencies. The last time this coincidence occurred was 1929 to 1932, leading into the Great Depression when prices for commodities and output prices for consumer goods fell heavily. With unsound money and a central banking determination to maintain prices, illusions of prosperity may continue to exist, but depression conditions will exist nonetheless." End of quote. So, Alasdair, welcome, and I'm so happy that you could join us today because not a happy topic for sure, but I think an enlightening one. And I want to ask you, you wrote that on October 3rd. Of course, the action in the equity markets today and yesterday too suggests that some people may be having second thoughts about ongoing prosperity. But what are your thoughts about today's action, perhaps, and the equity markets?
Well, it's a 1% fall on a net basis. I think it was somewhat more than that during the trading session. But the interesting thing is that I think people are waking up to the problem that trade tariffs are likely to cause. That seems to be cited as the reason that the market has gone easier, and President Trump has made comments to that effect. So, yes, I think the edifice may be beginning to crack a bit. Mm-hmm.
Yeah, you've been warning on this show at least a year ago or so that you felt the existing credit expansion was nearing its end. You felt even last year that we could very well be heading into a downturn as early as the fourth quarter of last year. Well, here we are. Now, of course, we know that recessions are always measured, after the fact, and we're probably into a recession long before people acknowledge that we are in a recession. But do you think, are you seeing signs right now in the real world, not in the stock market necessarily, but are you seeing economic signs that the global economy is slowing down a bit?
Yes, very much so. The problem with trying to judge it is, of course, the whole thing is priced in funny money. So right. You have a situation where, the world can be going to hell in a handcart and, the GDP appears to grow. So it does make it rather difficult if you're just a statistician trying to look at things like, PMI figures and inflation figures and all the rest of it. But the one thing that is absolutely clear is the volumes of cross-border trade, the sort of international trade, have actually contracted. That's almost come to a halt. Mm-hmm. And we see that the major economies who depend on America and or China are themselves running into difficulties. And there's no clearer example of this than Germany. Germany's economy is heading south quite rapidly, even in inflated euros. And we also have the worry that, of course, that the German banking system before this happened was getting into difficulties. I mean, quite visibly, we have seen the management at Deutsche Bank struggling with that behemoth, trying to stop it imploding. And the situation, I think, if you put if you like, a recession on top of that, this is an extra factor which actually could sort of destabilize the whole of the German banking system. And we're not even talking Italy, we're not even talking Greece, we're not even talking Spain. We're talking about the most important and strongest economy within the European Union. It is an extraordinary situation.
It is an extraordinary situation. I mean, you point out in your article that you had the confluence of those two events, the Smoot-Hawley in the 1930s and the expansion of the credit. Of course, Chairman Powell and all the central bankers essentially seem to be very, very worried about another 2008, 2009. They seem to try to make sure that they're out ahead of it, so that they're proactive instead of reactive. Looks like they expect that they're never going to allow credit to contract again, at least if they can help it.
I think that's right. You make a very good point about them being worried. I think they are extremely worried. They know that the expansion of credit has not rescued the global economy since the Lehman crisis. I mean, it appears as if the American economy, the German economy, the EU, whatever, have just been sort of stuttering along with a little bit of growth, but never coming up to their potential. But you've got to bear in mind that the numbers that they're looking at in terms of real growth are after a heavily suppressed rate of inflation. I mean, the deflator, they say, is around about 1.5% to 2% in most of the major economies. There's no way it's that. It is considerably more. Now, you just got to look at Shadow Stats numbers or the Chapwood Index. Mm-hmm. Now, in America, it appears and they confirm each other, the current rate of price inflation is in the order of 9 or 10%. Now, if you use that deflator on your GDP, then America is already in a recession, and a very deep one, a slump, if you like. And it has been that way more or less ever since the initial shock after Lehman. So we have a situation where, overburdened with unproductive debt, I mean, you can go on and on and on about all the things that are wrong. And then on top of all this credit expansion, as you point out, we have a Smoot-Hawley-like hit, because America and China are ratcheting up tariffs against each other. And, what we're doing is we are turning the whole economy into the most enormous crisis by continuing with these policies. And bear in mind, it's not just one cycle that we're looking at from the Lehman crisis. We're looking at all the cycles which haven't washed out the bad debt, going all the way back, certainly into the late 90s, and probably quite a bit earlier. And you could even go back and make a case and say that this is a culmination of something that really started in August 1971, when Nixon suspended the Bretton Woods Agreement. In other words, the ability of just a few players in the big markets, like the central banks and the IMF and the World Bank, actually to redeem their dollars for gold. That was suspended at that stage. And ever since then, of course, monetary inflation has just been rip-roaring.
Yeah, for sure. And it's going into the financial sector, especially since... especially starting in the 1980s, I would argue, we started seeing this huge bond bull market, which is really transfer of wealth, and of course manufacturing and the sort of wealth-creating industries left America and went to China, and went to Mexico and other places. But you talk on page 2 of your latest, or of the October 3rd report, you talk about credit cycles within credit cycles and their increasing force, and that reminded me of an article that you wrote going back. 150 years of bank credit expansion is near its end. I mean, this sounds very almost cataclysmic, what you're talking about here. Could you explain that? I mean, 150 years going back to the Bank of England, I guess, way back, the 1800s.
Yes, indeed. I mean, we're going back to the Bank Charter Act of 1844, which is otherwise known as Peel's Banking Act. And basically what that did was that it set the terms whereby the Bank of England would back every note issued physically by gold. And in those days, the sovereign, we had the sovereign. The sovereign was £1. It's now over 300, by the way, just as a matter of interest. But it was a pound, and as a pound, well, they called it sterling because originally we were on silver standard. But what it meant was that the Bank of England would not print another £5 note without having 5 sovereigns worth of gold added to its reserves. Now, that was absolutely fine. That's a sensible gold standard, gold exchange standard, however you like to call it, system. But what they missed was that banks, commercial banks, in their lending could actually expand the quantity of credit, which was turned into money as soon as it hit people's deposit accounts. And so you had fiat currency in the middle of this, which couldn't be identified as different from money which was actually properly backed by gold. The consequence of this was that you had a cycle of credit. And we had the Over-End Gurney crisis, which I think was 1867. Over-End Gurney was the biggest discount broker in London, discount house in London, and they were doing so well in this sort of credit expansion that they then sort of invested in things like railways. And of course there was a railway crash and it wiped out Over-End Gurney. And then you had the Baring crisis. That was, I think, for something like 1890. And when Baring, that was their first crisis, by the way. They had another one. Went wrong 100 years later. But they invested in the Argentine, which actually was a wonderful economy and all the rest of it. But it was a bubble. And next door in Brazil, there was a bubble as well. So guess what happened? I mean, the thing blew up in Baring's face. And if at that stage the other banks hadn't rallied around, helped by the Bank of England, coordinated by the Bank of England and Nathan Rothschild, if they hadn't rallied around Baring's, it could have wiped out the whole financial system. But this is a cycle of credit, and people just don't seem to understand that when they look at the boom and bust sequence, that the origin of it actually is the expansion of credit and then the catastrophe that always comes at the end of an expansion. The reason I'm going on about this is that this time we are seeing the culmination of several cycles, potentially, which really does mean that this one is going to be a big one. Now, a big one, I think, has a more than likely chance that it will take out the fiat currencies. In other words, the fiat currencies, through this process, will themselves begin to collapse. Why? Because following the Lehman crisis, the central banks know that the only thing they can do is to just chuck new money into the system as much as possible to keep it going. The amount of money that's going to be required this time is considerably greater than was required at the time of the Lehman crisis. Now, this is why we're beginning to see central bankers really worrying about it. We see the Middle European countries accumulating gold, and not only that, but making sure they've got control over the gold. They're telling the Bank of England, come on, we want our gold at home. So, and these are people who have, most recently suffered from communism. They know the consequences of the socialization of money. And some of the brighter brains there are beginning to say, we've got to protect ourselves because there is a tsunami coming and we don't want to be wiped out for a second time in 40 years.
I'd like you to try to explain to our listeners, if you can, the most recent experience, of course, we had was 2008, 2009, when we had this credit collapse. It almost got away from the central bankers. I think you'd agree with that. And then we had, at least for a brief period of time, collapsing prices everywhere because it had a snowballing effect. So most people believe that that's what we'll have again if we have any kind of problem at all. They can't really see rising prices. And we did, I think you would acknowledge, we did have a very brief period of deflation, or at least collapsing prices in the real world, not just in the financial markets, but in the real world, for a brief period of time. And then they started stimulating and pumping money into the system again. Are you suggesting that this time they may not be able to get it to revive it again and have another cycle, catch the falling knife, as it were? They seem to have done in 2008, 2009. That this time may be the culmination of a major, going back as much as 150 years, a whole cycle of credit?
Well, the 150 years cycle, I'm really standing back and looking at the big picture.
Right.
But what you describe post-Lehman is a perfectly natural thing. I mean, you get just too much capacity in the economy. People are making too many of the same thing. And so when that went wrong, I mean, we remember cash for clunkers.
Sure.
You know, in this country, in Britain, we had a similar scheme. And I remember in the wake of that, there were some car manufacturers, I think Citroën in particular, who were almost offering on some models, buy one and get one free. You know, they just had to clear, because there were no buyers for it. You know, so they had to get rid of stock at any price. Even Mercedes. I know of people who bought Mercedes at a 40% discount to the list price. And you know, there were very few motor manufacturers who actually went through that without having very substantial cuts in price. So that happens when you get the crisis. When the crisis hits, suddenly you find that you know, people who would normally buy things on credit, whatever, they recoil. They stop doing that. So you get that moment. But inevitably what happens is the central bank steps in and then really throws money at the problem to try and get prices up, because they believe that the only condition which is healthy is rising prices. So they're going to bring that about as quickly as they possibly can.
Well, that was the same idea as the 1930s, wasn't it? I think our Federal Reserve, our president, the executive, and the Fed really tried to keep prices up as well, right? They didn't.
Yes.
They weren't very successful.
Well, there were two elements of that. I mean, President Hoover was trying to support prices, which basically meant that nothing could be sold. The other thing is, bear in mind that in the 1930s, the world, and particularly America, was on a gold standard. So prices were in effect in gold. And it was that led to the 40% devaluation of the dollar measured in gold from $20.67 to $35 in 1934. So, you know, the situation basically is one that leads to that sort of pressure on the currency. But I think it's going to be enormous this time, given the amount of fiat that's been printed since the Nixon shock in 1971.
So what is the solution for individuals? I mean, obviously, gold has been rising relative. Gold's purchasing power has been holding its own. The dollar's has not. The dollar's purchasing power, as you pointed out earlier, hasn't held up nearly as well as they pretend it has. And the middle America, we have the opioid crisis. We have people that used to work in manufacturing in the middle America, the people that voted for Trump primarily, are hurting really badly, while the intelligentsia, the people on both of the coasts that are involved in government or in the military-industrial complex or what have you are doing quite well, and they tend to be Trump haters, so more or less, generalizing. But in terms of gold, we've had sort of depressed I mean, gold continues to buy much more, and the dollar continues to buy much less. So I guess if you use gold as your currency, we've had declining prices. If gold were our money, right?
Yes, absolutely. I think the way to look at it is that the dollar will lose purchasing power, as will the euro, as will sterling, as will the yen. They'll all lose purchasing power. And the faster that the central banks produce new money, QE, if you like, then potentially the more rapidly fiat currencies will lose their purchasing power. The only thing you can do is get out of fiat currencies, basically. And then what we're looking at is we're looking at gold. If you want to speculate a bit, possibly silver. Some of the younger guys listening to your radio show might want to go for Bitcoin. I wouldn't put them off doing that, but just get the hell out of fiat currencies. And the problem is we hang around waiting for it to happen, and waiting, and we look at gold, and we think of gold in terms of dollars, and we think, well, it's currently trading at 1470. It's rallied up from 1454 in the last 4 sessions. I think I'll wait until it comes back a bit. I mean, you can play those games if you like, but actually, this is a lot more serious than a little bit of speculation and trying to save $1 or $2 on the gold price.
Mm-hmm. So your bottom line, then, the advice that you give investors and just common folks is to get out of fiat if you can. Of course, pay off your debts if you can. And that's where a lot of people are going to be hurting really badly because there's so much debt.
Well, debt. Sorry, if I can interfere. Yes, if I can cut across you. By the way, I don't give investment advice. I'm looking at monies,
I understand.
Different monies. But when it comes to debt, it's an interesting one because private individuals across the world are now so much in debt that if the system collapses, then it's not just you, it's your neighbour, it's everybody else who is in exactly the same position. Now, that puts you in quite a powerful political position. So in a sense, if you've got a mortgage on your house, as long as you can continue to make the payments, you will probably see the thing through until the value of the repayment value of your mortgage is actually depreciated so much because of all the money that's been produced that you're probably going to be all right. So you've got to take sort of quite complex decisions of that sort. What you don't want to be is alone, because if you're alone and you're in trouble, nobody's going to come and rescue you. Right. If you're in there with millions in exactly the same situation, then basically the government will do everything they can to protect you. Not you as an individual, but collectively. Collectively. So these are the sort of things you've got to think through, I think, quite carefully.
Alasdair, I don't know if we'll have you on with just 30 seconds left. We're coming to the end of the year. Will we see higher gold prices by this time next year than we see today? Today's gold price is moving up close to $1,500.
I will put it another way. You're going to see a lower dollar.
Okay. That's a good way of putting it, because we know that the gold is a constant measuring stick, isn't it? And it's the dollar that fools us. People think
money.
Everybody thinks in terms of the dollar, but it's really gold they should be thinking of. Alasdair, thank you so much for being with us again. And if we don't talk to you until 2020, Happy New Year to you, and happy holidays.
Well, thank you very much. It's been great being on, and I just want to wish all your listeners a not too bruising 2020.
Let's hope it's
a lot better than I think it will be.
Yeah, let's hope you're wrong. But it's better to be prepared than not to. So thank you so much, Alasdair. We'll talk to you again soon.